37.6 million ounces disappeared in 47 days, pulled out of COMEX vaults, the biggest drawdown since 1980. And what happened in 1980? Silver surged to $49, and the entire futures market came close to breaking. February 14, 2025. 4 major South Korean banks halted silver sales. No warning, no timeline, just stopped, indefinitely. China restricted public access to physical precious metals. Russian participants were removed from London trading venues. And right now, something is unfolding that shouldn't happen in a stable market. Spot silver is trading above futures contracts. That condition is called backwardation. In simple terms, buyers are paying a premium to get silver today instead of accepting a promise to receive it later. That's panic buying. This isn't a simple price rally. This is stage 3 of a 4-step pattern that has repeated throughout recorded history. And when stage 4 hits, the number on the chart won't matter, because at any price, you won't be able to get the metal. This pattern has appeared 3 times before. 3 times early observers built generational wealth. 3 times everyone else was left stunned, asking what just happened. By the end of this video, you'll know exactly where we sit in the cycle, why this round is different, and what the Hunt's $17 billion disaster teaches about what not to do. Here's the pattern. It's brutally direct. Stage 1, establishment. A commodity becomes money. Governments anchor currency to it. Prices stay stable for decades. Trust is universal. Silver was in every U.S. coin until 1964. You could take $1 to a bank and walk out with silver. Predictable, steady, real. Stage 2, manipulation. Someone discovers they can create paper claims on physical metal. 1 ounce becomes 10 contracts. 10 becomes 50. 50 becomes 100. Paper is cheap. Physical is not. So the market floods with promises. Prices fall because it appears supply is infinite, but it isn't. Stage 3, the squeeze. Demand rises. Buyers ask for actual delivery. Vaults drain. Everyone realizes at the same moment that the metal won't cover the contracts. Panic follows. People rush to convert paper into physical, but the ounces don't exist. Stage 4, the break. The paper system fails. Trading stops. Delivery defaults cascade. Physical goes vertical, while paper claims evaporate. Those holding real metal win. Everyone else learns the cost of owning a promise instead of the asset. That's why price becomes irrelevant. When stage 4 arrives, there's no paper price, only physical, and availability becomes the only number that matters. And I'm going to prove, using COMEX's own data, that we are already deep inside stage 3. But first, you must understand why silver is unlike any other commodity. Gold serves primarily as money. Silver serves as money and the backbone of modern technology. Your phone, silver; solar cells, silver; automotive electronics, silver; medical devices, silver; 5G infrastructure, silver; advanced weapons systems, silver. Every cornerstone technology of the modern world depends on it, and supplies are shrinking. A 148.9 million ounce deficit in 2024, the 4th year in a row. We're mining less, consuming more. The solar sector alone could drain 85–98% of global silver reserves by 2050, according to research from the University of New South Wales. Now watch what happens when we overlay this pattern onto the events unfolding right now. But before we map the pattern onto today, let me show you the most dramatic historical confirmation of it. 2 brothers, 200 million ounces, and a strategy that nearly cracked the entire financial system. Nelson Bunker Hunt and William Herbert Hunt, Texas oil billionaires. In 1979, they began buying silver, not modestly, aggressively. They accumulated 200 million ounces, half in physical bars, half through futures contracts. Their thesis: the dollar was deteriorating, inflation at 13%. The gold standard abandoned in 1971, fiat money losing credibility. Silver represented real value, and they weren't wrong. January 1979, $6 an ounce. September, $10. December, higher again. January 17, 1980, $49.45, a 724% surge in a single year. The Hunts were suddenly among the wealthiest individuals in America, and Wall Street was alarmed. Why? Because the Hunts weren't just buying paper, they were taking delivery, draining the physical supply. And they were leveraged, controlling more metal via futures contracts than they could purchase outright. Every contract represented a claim on physical silver, and they were demanding that metal. COMEX panicked. Vaults were emptying. If the Hunts continued requesting delivery, the exchange risked breakdown. So COMEX responded the way exchanges do when pressure turns against them. They rewrote the rules. January 7, 1980, Silver Rule 7. No new long positions allowed. You could sell. You could hold what you already had. You could not buy more. In other words, the Hunts were being locked out. But prices kept rising anyway. Until January 21st, when margin requirements were raised sharply. Overnight, holding silver futures became financially punishing. The Hunts suddenly needed hundreds of millions in new margin. They scrambled, they sold. Others joined the selling. March 27, 1980. Silver Thursday. Prices collapsed from $21 to $10 to $80 in a single day. The Hunts lost $1.7 billion. They filed for bankruptcy. Brokerage firms were pushed to the brink. Banks froze credit for 48 hours. The system nearly failed. But here's what most people ignore. Those holding physical silver, not contracts, not leveraged positions, but real metal, didn't lose anything. When the chaos cleared, silver settled around $10, still 66% above where the move began. Anyone who bought physical at $6 and simply held came out far ahead. The Hunts failed for one reason. They trusted leverage and paper. When the rules changed, their paper positions collapsed. But no one can rewrite the rules on metal you physically own. That lesson matters, because today's setup mirrors the 1980 structure, but with deeper distortions. Remember 1971 when Nixon suspended gold convertibility? Same pattern. Foreign holders demanded physical gold. The U.S. didn't have enough to satisfy claims. Convertibility ended. Gold surged from $35 to $850. Silver climbed from $1.40 to $40. Both metals signaled the same thing. When physical backing disappears, the currency weakens and tangible assets explode. The same dynamic crushed palladium traders in 2001. Russia controlled most of global supply and delayed shipments. Physical metal vanished. Prices jumped 263% in 2 years. Paper traders lost everything when delivery became impossible. Those holding physical metal gained massively. 3 examples, 1 pattern, 1 outcome. Physical wins, paper loses. So where are we now in silver's cycle? Let's look at the data that was released this week. Stage 1, complete. For 150 years, silver functioned as money. U.S. coins contained 90% silver until 1965. You once exchanged dollars for silver at face value. Then, in 1965, silver was removed from circulating coins because the metal became worth more than the denomination stamped on it. That should have been the warning. The market valued silver higher than the government's fixed price. Instead, silver was reclassified as an industrial material. Stage 1, complete. Stage 2 followed. When silver stopped functioning as money, Wall Street built its paper ecosystem. Futures, ETFs, certificates, derivatives. For every physical ounce, they created 50, sometimes 100 BC, paper claims. The largest ETF, SLV, reports 440 million ounces under management, or so the filings state. Read the prospectus. If physical metal is unavailable, redemption can be settled in cash, meaning your silver might be nothing more than a promise to pay you money if the price rises, not actual metal. COMEX total vault holdings, 265 million ounces. Registered for delivery, 43 million. So when traders request delivery, only 43 million ounces exist to satisfy hundreds of millions in outstanding contracts. See the structural flaw? For decades, the system held. Most traders closed in cash. Industrial buyers received material. Banks collected fees. Until now. Stage 3 is active. October 1st, 2024. COMEX showed 80 million ounces registered. December 3rd, 2025. Only 43 million. That isn't normal liquidation. That's a run on inventory, and it's accelerating. November 17th, 613 million ounces withdrawn in a single day. February 14th, 2025. 4 major South Korean banks suspended silver sales simultaneously. Not for a day, indefinitely. These are institutions with deep capital and global sourcing networks. If they cannot obtain supply, what does that imply about actual availability? China elevated risk categories on precious metals. Citizens cannot purchase through banks anymore. Why? Because the state is accumulating. Exports restricted. Physical deposits now required for futures participation. They're preparing for something. India's silver imports broke records in 2024. Indians have lived through currency stress. They understand that when paper falters, physical metals preserve value. Now add industrial demand. Solar production consumes 12% of annual silver output. Electric vehicles require double the silver used in combustion models. 5G networks. AI server farms. Every modern technological trend increases silver consumption. Supply has declined since 2016. Recycling isn't compensating. A 148.9 million ounce deficit in 2024. Projected 117.6 million ounce deficit in 2025. And now investors are reacting. ETF inflows are surging. Retail buying at levels unseen since 2011. Online dealers report shortages, rising premiums. When you pay $5 over spot simply to obtain physical metal, the paper price is no longer telling the truth. And backwardation, spot trading above futures, signals physical urgency. Futures should be more expensive due to storage and time value. When spot exceeds futures, it means buyers are paying extra for immediate delivery over future promises. We are deep in stage 3. The squeeze is happening. Stage 4 hasn't arrived yet, but we're on the threshold. CME halted trading in November 2025. Official explanation: cooling system failure. A cooling failure in a market built with military-grade hardware processing trillions? Veteran traders know when exchanges freeze mid-spike, someone significant is under stress. COMEX now faces 2 choices: rewrite the rules, as in 1980, by raising margins, capping positions, restricting delivery, or let the market run and watch prices go vertical, which seems more likely. They will try to contain it. But here's the real issue. This isn't 2 wealthy speculators from Texas. This is global demand, industrial sectors that must have silver, investors across multiple regions, central banks accumulating, BRICS nations building parallel systems. You can rewrite rules for a handful of traders. You cannot rewrite them for the entire world at once. When stage 4 fully arrives, trading halts become routine. Delivery shortfalls stack on top of one another. Contracts get closed out in cash against the buyer's wishes. Premiums surge. Spot sits at $60 while physical dealers ask $80, $90, $100 just to provide metal. Then one day, the paper market stops outright. Contracts are suspended. Lawsuits follow. Regulators intervene. And those holding physical metal simply observe from the sidelines because their outcome is already secured. This isn't guessing. It's pattern recognition. And the pattern is shouting. So here's what matters. First, understand this difference between owning and speculating. Trading paper for short-term profit. That's speculation, and it comes with risk. But buying silver as protection, as a store of value, as insurance against monetary breakdown, leaves only one viable path. Physical metal under your control, not in a vault you can't access, not in an ETF, not in a futures contract, in your possession, where you can verify it, hold it, secure it. That is ownership. Second, acquire while premiums remain manageable. Right now, physical silver is available at roughly $5 above spot. When the squeeze accelerates, premiums won't be $5. They'll be $20, $30, $50 over spot. Eventually, there's none available at any premium. Dealers empty. Mints quoting weights measured in months. You stand there with currency losing purchasing power, unable to convert it into the one asset still rising. Third, prioritize forms with instant liquidity. Standard coins, standard bars from widely trusted mints. Avoid collectibles. Avoid numismatic pieces. Avoid novelty designs. The goal is simple: pure metal in formats universally recognized. American Silver Eagles, Canadian Maple Leafs, 100-ounce bars from established refiners. Liquidity is everything when the system fractures. Fourth, size your position wisely. This isn't an all-in scenario, it's allocation. 10, 15, maybe 20% of assets, enough to be protected if the pattern completes, but not so much that an unexpected shift puts you at risk. Balance caution with action. Fifth, store correctly. A home safe, a bank box, if you're comfortable with that. a private vault, if you prefer. But always maintain control. No custodians holding your keys. The entire purpose is eliminating counterparty risk. Don't recreate it through poor storage. The window is narrowing, not because someone predicts it, not because of hype, but because vaults are draining, banks are stepping back, backwardation is signaling physical scarcity, the market is stating the truth. You only need to pay attention. Every fiat currency in recorded history has failed. Every one. Average lifespan, 27 years. The US dollar, fully fiat since 1971, is now at 54 years. We are beyond statistical expectancy. And you cannot print silver. You cannot manufacture it through legislation. You cannot solve a structural deficit with algorithms. Physics doesn't respond to financial models. So here's the question. Will you wait until the break occurs and regret inaction? Or recognize the pattern, trust the data, and respond while the opportunity still exists? The choice is yours. But the window won't remain open indefinitely. If this made sense, if the pattern is clear, subscribe now, because this is just the surface. The pressure in the silver market is one symptom of a much larger structural unraveling. In the next video, I'll take you through the currency stress, the debt trajectory, the derivatives exposure, all following the same four-stage pattern, all converging toward the same endpoint. Subscribe, watch the next episode, and learn how to navigate what's ahead. Those who see the pattern early don't just endure the shift, they benefit from it. The clock is ticking.